Today, we are talking about GASB-87 leases, but focusing just on the lessee accounting and financial reporting, the pitfalls and implementation issues that we've already encountered with a few of our clients, and also some potential audit issues. And I say the word potential. And I emphasize it because the 2020 AICPA Audit and Accounting Guide for States and Local Governments, which came out a few weeks ago, only contains summary information for GASB 87, similar to what occurred for other major statements such as GASB 68 on pensions and GASB 75 for OPEB a few years ago. For the year that those standards were issued, they just contain summaries of it and no real audit guidance on it, even though there might have been some governments out there that implemented GASB 68 and GASB 75 early. I don't know of any, but there might have been some that did. Perhaps the thinking on GASB 87 was that not many governments would implement early due to COVID or, simply because of the complexity of implementing GASB 87, but some governments have. To sum up the implementation of it in terms of how hard it is or not so hard it is, certainly I think, at least from our experience in implementing, it's not as hard as pensions and OPEB. Obviously, that's highly government dependent as to what your plan is and so on. But it really, it can be. It really depends on a lot of factors, which we'll discuss over the next nearly 2 hours here. So today's agenda is going to focus on a review of GASB 87 for lessees, and I'll talk about some of the lessons learned from a government that has implemented, the steps to implement, and resources available, and some key focus areas that are likely to be involved in the audit of this information. I know what you're saying. Maybe you've heard some of this before, or you say, oh, I still have time to get to this, or it's not a big deal. Well, you might not have some time to get to this, and it might be a big deal. It really depends on your policies, procedures, and internal controls. And finally, in the words of one of my former colleagues, 10 times for the normal mind, 100 times out of stress. I think I said that about 5 times this week already, and it's simply because of the world we're living in, especially nowadays. GASB 87 is not as bad as implementing the defined benefit pension or OPEB standards, but it's really government dependent. It may come close in terms of your effort. And with that, that leads to our first polling question. And so it says, my government status in implementing GASB 87 as a lessee. You have item A there, we named a project lead and have gotten going. Item B, we're on our way and hope to get finished. C, we haven't started yet, but know it's there. And item D, what's GASB 87?
It looks like most people are choosing C.
Yeah, we haven't started yet, but we know it's out there. I'm not surprised. And, a lot of folks are focused on COVID or state and local, budget deficits that are going on, watching what's happening about 3 miles or 2 miles down Pennsylvania Avenue from where I'm sitting, down on Capitol Hill. A lot of folks are waiting for maybe some stimulus going on, or it's just, one of those things that you say, oh, I'll wait till the auditors show up and then, oh yeah, I'll start implementing the brand new GASB standard. There isn't a right or wrong answer to this one, but I think once you get through the next hour plus, you'll realize that you may want to get started sooner rather than later. So thank you, Nanette, on that one. So as I just mentioned, time, again, we're all under stress at the same time. There's a lot more going on in the world other than GASB 87, but we need to go through some of the basics. The world of leasing is changing for every organization globally. The impact of the change is probably most felt by non-governmental entities such as banks and financial services entities who are lessors of things ranging from buildings to commercial airplanes. And by the way, those for-profits have similar standards to what we in state and local governments have. And by the way, not-for-profits have similar standards to what we in state and local governments have. You know, the world of leasing, again, is changing for every organization globally. And so we need to be cognizant of the fact that we're all in this together. All governments will be implementing at the same time. Tribal nations, airports, ports, marinas, utilities, casinos, and entertainment venues that happen to be governments, all are implementing this year and certainly next. Due to the change provided by GASB 95, which we talked about a few months ago, there is an extra year to implement, but that year begins for June 30 governments in just a short time. You know, that's not a lot of time for leases that are pretty complex. For December 31st governments, you have a little bit more of a reprieve out there. But again, given the complexity of GASB 87, you may need to get started sooner rather than later. GASB 87 requires a beginning balance adjustment, which for some governments is likely going to be material. This is a standard where you do not want to wait for your Eide team to, send you a notice saying, hey, we're getting ready to start interim. Hey, how you doing on implementing GAP? And then you say, oh, yeah, what's GASB 87? Oh, yeah, I got to start doing it. This is not one of those standards, and you will need the time. There are certain aspects of the new standards that are easier than other aspects, but by and large, the standards that release that impact all of you have been around since the 1970s, and in some aspects, the 1940s. These are really long entrenched provisions that truly needed to be updated for our current conceptual framework and our current practices and procedures. I mean, think about it. Is there anything around your office other than maybe your office that you've been using since the 1970s or even the 1940s? I mean, maybe you're in one of those buildings that's pretty old, but there's not a lot of us that have been around since the 1940s working, that's for sure. Again, these are really long entrenched provisions that have been around since way before the GASB. For my generation, taking the CPA exam, we memorized what I used to call in my account, and I learned it from my first accounting professor, the famous four, as he termed it, talking about the old FASB 13 on leases. And when I learned, it was relatively new back then. For the most part, FASB 13 became GASB 13 in 1993. And again, well before many of your time. The capital lease provisions were codified by GASB 62 in 2012. And maybe, yeah, there's a lot of you that's maybe before. Now, in some cases, software has been longstanding with these decisions and analyses built in, including whether or not you have a lease term of 75% or more, or there's a bargain purchase option, or ownership transfer, and so on. There was a system that I implemented back in 2002, which was the first large ERP system on the internet. And in the first year, we did 40 million transactions, and it took a complete overnight to do 1 day's worth of business to calculate it. That's how far we've come in a short period of time. But we had this analysis built in of the four factors. The present value of the minimum lease payments is 90% or more of the fair value. The lease term is 75% or more of the asset economic life. There's a bargain purchase option, or if ownership transfers. If you hit one of those, it ended up being a capitalized lease. And it was just a checklist that was built into the ERP system. So clearly things are going to be changing due to GASB 87 and of course the FASB counterparts. So what is a lease? A lease is a contract that conveys control of the right to use a non-financial asset, also known as the underlying asset, for a period of time as specified in the contract in an exchange or an exchange-like transaction. Each of those phrases is precious because guess what? You're going to see that language over and over again in GAAP coming up, and during our next webinar coming up in November, when we talk about the lessor side and other related standards. You're going to see that phrase over and over again when we talk about public-private partnerships and public-public partnerships and availability payment arrangements. And you're going to see it, of course, with regard to subscription-based information technology arrangements. It's the same standard. And you know, again, we're dealing with a contractual arrangement which gives your government the right to use a non-financial asset for a period of time as specified in the contract in an exchange or an exchange-like transaction. And so if you do have a printout of these that you printed out from the Zoom link that was sent around, you know, fold back this page or you know, dog-ear it or something, because again, it is a big change in GAAP. Let's talk about exchange and exchange-like first. An exchange is value for value and not a forced transaction. So we're not talking about eminent domain where a judge says, okay, you got to give up that piece of land to the local government. No, that's not what it is. The values equate to the services acquired or expenses incurred or liabilities paid for. Again, the transactions are not forced, so we're not talking about bankruptcy or qualified domestic relations orders related to a divorce or something like that. You know, your government is not forced to sign a lease. You don't have to enter that transaction. And that's an exchange transaction. An exchange-like transaction is not entirely value for value. The most common one you may deal with, maybe in your own personal life, you know, if you're going to build a house in a subdivision or maybe put in an addition or something like that, is building permits or development rights. You know, the property taxation on your new wing or your new roof or your even new house, the property taxation on that property value change doesn't equal the value of the permit. So because the value of the permit is maybe $50 or $100 or something like that, but without the permit, you have no development or construction. Here, you know, here I'm sitting in Georgetown, DC, and it's in the middle of a historic district. Nearly every house is historic because Georgetown predates the entirety of Washington, DC. It was here before Washington itself was established. And many of the houses predate 1800, including the one I'm sitting in right now. And so clearly, if you're going to put in new windows or a new roof on this particular house, you got to go to the historical commission and pay your $100 once they approve it, and the value, of course, goes up. A lease could be involved in an exchange-like transaction, but the more common transaction is an exchange transaction, again, equal value for equal value. When we've implemented at our clients, we had issues here in the contracts we analyzed. There were a bunch of contracts that were non-exchange or exchange-like. You know, mainly what we ran into are things like land swaps or easements or utility lines and access roads, all of which were termed as leases, but really weren't leases in practice because they didn't fit the definition of an exchange or an exchange-like transaction. Let's put this concept into practice. So let's say I have a right to use piece of land with a fair value of $100,000 in rent per year, but the government is only leasing it for $1. Well, that's not an exchange transaction. That's not an exchange-like transaction because the value of the land rented is far higher, and therefore it's not value for value because, as we know, $100,000 is far different than a dollar. A permanent easement is also not value for value, and of course, since it's permanent, you have no lease term, which is really going to be vitally important. And so you're going to see a lot of these that are out there. There are some exceptions from the lease provisions where we don't have to do any analysis. We can just set these aside and say that the vast majority of these are contracts, but be careful on these ones. Contracts involving mining rights or oil rights or patents or software for now, because that one will change, the year after you implement GASB 87, but with similar provisions, and that's what we're going to talk about during the next webinar in November, GASB 96. So for now, if you do have these sort of software arrangements that are out there, and they're far more than just the blanket phrase of software arrangements, just set these aside into a different bucket. We're going to get to those in a little bit. Living plants and animals, such as those in zoos, that's exempted. Your government may have power purchase agreements, especially solar panels on buildings. That is very, very common. My town in Massachusetts, where we live permanently, just sent a notice last week that every school building in town and even the town hall will have panels on them by the end of the year. And they wanted to give all the neighbors and the abutters notice. I have a school across the street from my house, and they just wanted to let everybody know that just in case there's a reflection or there's banging putting this stuff on the roof, and we were waiting for that. They just built the school for over $200 million over the past couple of years, and the neighbors were saying, why not put solar panels on them right now? Well, they delayed it for a year. If the agreements are to purchase power, they're really supply contracts if they don't convey control of the panels to, in this case, the town. However, the fixtures themselves to the building could be in fact party to a lease. So you got to be careful to that on that one. The purchase of an asset is also common, but it's really a mortgage note. And so just really be careful on some of these provisions. Notice I say beware about service concession arrangements. That's going to be a public-private partnership or availability of payment arrangement or a public-public partnership. Be careful about conduit debt that is titled to be a lease to get around some debt limitation. That could be conduit debt coming up in the future. So the biggest change due to this definition is, again, no classification between operating and capital leases. There's no more pretzel logic needed just to fit around the accounting definitions from decades and decades and decades ago that we talked about, some of which come from the 1940s. Since the lease is really financing a piece of property for a specific time frame, and in your government has use over that property during that time frame, then you do have control because you have present service capacity to use that property. The financing language is common, and we need to be careful to look for that in much of our documentation. In many cases, contracts that are currently reported as leases are really financed purchases, and that's a very common thing. If you look on page 88 of a lease that is decades old, you may have a provision that is in your documentation that says, on such and such a date, say January 1st of 2025, insert the name of the government may buy the piece of property for $1. That really is a purchase agreement, although it might be a lease simply to get around some form of limitation, be it in law or regulation or something similar to that. The only time that your government would record just an outflow of resources like our current operating leases would be for a contract that has the maximum possible term under the contract of 12 months or less, including any options to renew or extend. Think about it. If you ever leased an apartment, chances are it was an annual lease, because guess what? The market rate changes every single year. And so the landlord wants to renegotiate that to the current market rate or whatever the terms and conditions are. And so there's usually not a right to extend or renew. It really is dependent on those facts and circumstances. So another example, Mike, I lease a car, and as most people in the Northeast lease cars for some strange reason, simply because there's just not a lot of room to drive, and my car is coming off of lease, and I got notice from my leasing company, Toyota. But I said to them, I only have 18,000 miles on my car, and it's almost 3 years old. And by the way, with COVID, you're delaying building of new cars for 2021 of the one I want. And because I called my dealer up and I said, gee, when are you going to get this particular car? And the saleswoman said, well, maybe not for 6 months. And so I called up the financing person and said, hey, can I extend the lease, go month to month? And he said, sure. How many thousand miles on the car? And I said, well, 17,800. And he said, oh yeah, we can extend for 6 months. And so there was a lease renewal option. And so if I was the finance company, I would say, gee, instead of 36 months, I got 42 months. And because there was an option to extend. And so, uh, and so let's talk about the term and why it's important to determine, when you're going for your own home mortgage, it's just like a lease. There are three important elements: principal, interest, and time. And, we learned that when we were in accounting school. We said PIT, principal, interest, and time. For a lease, the time element is perhaps the most variable. In GASB 87, it includes all of these factors, which I'm not going to read. But what I want you to focus on, are the options, which are bullets 2, 3, 4, and 5, and perhaps even 6. These bullets are really important because it gives you a little bit of wiggle room in the lease term. It includes the option to extend if it is reasonably certain of being exercised. And notice I put in the definition of reasonable certainty. It is more than probable. And for those of you who do, the accrual of claims and judgments and so on, or legal cases, about probable and estimable and remote and so on. Reasonably certain is more than probable, and that comes from the basis for conclusions to GASB 87. That's what the board deemed, and so you really got to be sure you're going to renew that lease. And in many cases, the lease does not contain option periods, and so you don't have to worry about bullets 2, 3, 4, 5, and 6. But notice who has the option. Is it the lessee or the lessor? And notice that it has either renewal or extension or termination. These days, with COVID, you just walk down your local main street and you see a lot of lease terminations going on. I mean, here, in Washington, D.C., you just walk down M Street, which is a major shopping mecca during normal times, and it would be crowded with shoppers. And Wisconsin Avenue or Connecticut Avenue as well. Those are store after store after store, and all you see are papered up stores. And so there are a lot of lease terminations going on there. And now there could be situations where the periods have both the lessor and the lessee both have the option to terminate or to extend, or you must agree to it, and you have to take that into account. And you also need to take into account whether or not you made a judgment and then that judgment changed based on facts and circumstances, which is pretty much what I did with my leasing company. I said, gee, I usually turn in my car every 3 years, but now because of COVID, I'm keeping it for another 6 months. So that was a reassessment of the term. So in each contract, you're going to need to know these periods here. I went too far. In each contract, you're going to need to know these periods. And if there are periods for which, again, both parties have the option to terminate without the permission of the other party, or if both parties must extend, those typically are cancelable periods. And again, you need to figure out if there's some form of reassessment that is going to be needed, based on these adjustments. So here are some common cases that you may run into as part of implementing GASB 87. In the situation where a government enters into a 12-month non-cancelable period lease in which the lessee has options to renew for 12 months at a time, up to 49 times, well, this is not a short-term lease anymore. And, a lot of our governments out there, they had this exact clause in, and they said, well, it's up to the city council or up to the board of supervisors or up to some other governing body to appropriate funds to, continue on in the lease. That is not a short-term lease. The maximum possible term of a short-term lease is required to be 12 months or less, including any option to extend. And because you have renewal options, regardless of their probability of being exercised, the lease does not meet the definition of a short-term lease. Now, if the government enters into a lease with a 6-month non-cancelable period and an option to extend for another 12 months after the period, the government is not reasonably certain that it will exercise the option to extend. And therefore, in this case, the government assessed the lease term as 6 months. Well, this agreement is also not a short-term lease because there's a paragraph in 87 that says that a short-term lease has again a maximum possible term under the contract of 12 months or less, but there's an option here, right here in the middle, to extend. And therefore, the lessee would report a liability in a lease asset. But in this case, the lease term might be 6 months. But you just have to be careful as to what the language is on that one. Finally, if a government enters into a lease term with a lessor of 16 months and can cancel the lease at any time after 6 months, and here we have the lessor not having the option to cancel the lease. In this case, the maximum possible term is 16 months. Since in this case, we have a cancellation clause built in either by the lessee or the lessor. So you take a look at the non-cancelable period, and the intent of the provision that is in GASB 87 is to calculate the cancelable periods for which both the lessee and the lessor have the option without the permission of either party. Because only the lessee has the option to cancel in this period, in this scenario, the maximum possible term would be the 16 months that the lease could last, and therefore it's not a short-term lease. So this is a really tricky provision, and you really got to be careful on what is a short-term lease. And that leads us into our next polling question. And this is just sort of a gauge as to what your current state is. Thinking about our current government's leases as of today, what do you think? The most of the count of your leases are presented as either operating leases or capital leases, or I'm not sure, or we don't have any leases. At least that's what I think. Let me check. What do you think?
And the majority have selected A, operating leases.
Yeah, and I think that's where a lot of the action is going to be, is operating leases and moving over to what you used to call capital leases, but they're really not even capital leases anymore, and they really are operating leases. And a lot of us have these due to fiscal funding or legal constraints and so on. So let's get back to these big changes here. The lessees are gonna record the information from these mechanics, and you're gonna land up with an asset representing the right to use this piece of property, along with the liability based on the value of the fixed payments or variable payments, in adjusting for the factors in the time element. There's also interest involved in reducing the liability, just like a home mortgage. And determining the interest element is a little tricky. After all, the lessor may not tell the lessee what the interest rate is. The lessee may have to guess that as well. And in most cases in practice, so far the leases that we've seen so far, the lease discount rate was not stated in the contract. To calculate the liability, the most common are going to be fixed payments, but there's a ton of leases out there that are variable payments depending on an index or a rate. And that's, for example, the consumer price index, or variable payments that have minimums or maximums. And you that corridor lands up being a fixed in substance lease. It doesn't include payments that are dependent on usage or performance. So, for example, a mileage charge, like I lease a car, and if there was a mileage charge on top of my minimum lease payment, well, that doesn't factor into it unless, of course, I go over. And if I go over, well, that's just an outflow. It's not built into my lease rate. And that is very common. Another factor that is very common is hours used, for example, of a piece of equipment. That's just an outflow. And it's not part of your lease. Any sort of residual value guarantees that are fixed. Again, it's common in many automobiles where they have a residual value guarantee that is X% of fair value. That gets factored into developing the liability. Termination penalties may be present, and they need to be reviewed of probability of exercise. So, for example, let's say you cancel a lease because of COVID, there may be a termination penalty to your lessor, and whether or not you're going to exercise that, it needs to be factored into your liability. Now, the liability is calculated at present value, and it's amortized using the effective interest method. Again, just like today's capital leases. So let's get even more practical. We're going to lease some trucks on July 1st of 2021, the day we implemented GASB 87, and the trucks are delivered in the afternoon from a dealership in your government town or whatever, your county or city or whatever. The contract will be for 5 years with monthly payments, including $2,000 of a down payment at signing. The dealer said that the lease had a discount rate of 6% because of whatever was going on in the market at that particular time in 2021. The government can cancel the lease after 3 years, and at the contract end, the government does have the option to purchase the trucks for $12,000 each, but the government never does this, as they're DPW trucks and they're pretty beaten up. I mean, when was the last time that you saw a DPW truck that was in good condition when you returned it? It's usually pretty beaten up. So the controller's office of the government calculated the term at 5 years. Using Excel, And you can use Excel to implement GASB 87. The controller did the following calculation and came up with this amortization schedule. Now, I didn't include all 60 months as that would be really, really tiny print on your laptops, but the formula is right there. And so that's all you need in Excel to do this calculation. Now, there are some toggles built into the Excel, but for now, let's keep it simple here. The payment is due at the beginning in the effective interest method. Notice the interest is not $7,200 for the year, which is 6% times 120,000, and that's simply because of the effective interest method and the down payment that's going on. Notice the present value amount as this would be the asset and liability at signing, and for many small governments, you can use this calculation assuming the leases you have are simple. So just bookmark this page if you can. Again, the lease liability is based on the present value of the payments to be made on the lease term. And we did and still do get questions on whether the materiality threshold can be, whether a materiality threshold can be used. Yeah, but there's a big but. And I'm not talking about the seat of my pants. I'm saying, yes, there is a big however. Materiality cannot be calculated without knowing the whole of a population. Second, your own government's asset materiality could be very different than the materiality on your liabilities. Don't get caught up on the materiality trap without talking to us here at Eide Bailey if we're your auditor. So just be really careful. Many leases we looked at in our clients so far have had variable payments based on the consumer price index. The GASB implementation guide contains guidance of what to do with indexed leases. The variable payments that depend on an index or a rate are measured using an index. These are very, 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 very common. And again, if there are lease payments that are indexed to some other factor, such as CPI, there's going to be an outflow based on the change of the CPI in subsequent years. But in the initial year, you use the facts and circumstances as of the beginning of the term of the lease. Any variation from the amount paid in future years, again, is just an outflow or an inflow, basic, or actually a reduction of outflows in those periods. Again, usage payments are not included in the liabilities such as mileage, copies, and so on. So the lease asset can be amortized in any systematic and rational manner if the period is shorter, as long as the period is the shorter of the life of the piece of equipment or other asset that you're leasing, or the lease term. You can group all the assets together that are within a lease, meaning a fleet of sheriff's vehicles can be amortized as one group of vehicles, even if they can be substituted. And that's something straight out of GASB 34. We've been dealing with that for almost 20 years now, that you can group, like assets together and amortize them as a group. It's really up to the government what method is used, but I really would suggest the effective interest method if there's a chance that the lease will be modified or terminated. That method should be disclosed in your notes, just like your other some significant accounting policies that are out there. Now, notice that there's a phrase in the top chevron there that says that the lease asset is the initial lease liability plus prepayments less lessor incentives. And so if you do have a down payment on the lease, then that your lease asset price is going to, or your lease asset value is going to be very different than your liability. If you have an incentive, your lease asset is going to be very different than your liability. And incentives are all over the place now. You know, they just go open an app for leasing an apartment or leasing a car or something like that, and you can see all the incentives that are out there. So again, I encourage you to use one of these group or composite methods if you happen to, say, have a fleet of copiers or a fleet of sheriff's cars or something like that, you know, rather than doing things individually. Especially if there's a right of substitution. And again, remember the toggle here, you know, that your amortization is the shorter of the lease term or the useful life of the underlying asset that is there. Now, if indeed there is a purchase element that's in there, different story, you're going to align to whatever your policy and procedure is for a purchase of a capital asset, of course. And if the underlying asset is land, well, then there's no amortization that goes on because it just doesn't depreciate. An example here, hang on. An example of the useful life of, you know, say, a backhoe or a truck or something like that. I mean, let's say a backhoe that is not involved in our lease is 9 years of a useful life, and the lease term is 7 of a similar backhoe. Well, the amortization of the lease asset would be 7 years. Again, could it be straight line? Well, sure. It makes it pretty easy. However, if you modify the lease later in any way, like many are again today due to COVID, a gain or loss is more likely if you do it by straight line. So again, you may want to amortize the asset the same way as you do the principal and the liability. There are factors to consider, including components, incentives, modifications, and terminations. I really want to spend some time in components here. Components are really common, especially for space leases. These are separable elements in which each lease, including the common area charges such as maintenance, utility, security, landscaping, you know, you've seen these before and you'll see these again. In any lease, we're going to need to separate those components and estimate their value. Many of these CAM charges can be figured out by looking at similar contracts that don't involve leases. Don't take this one lightly. And in fact, I encourage you to look at your policies and procedures on this, on your contracts and so on as soon as possible, and try to identify components. Once the components are identified, separate payables for those charges need to be recorded unless it's not practicable to do so. The goal will be to maximize the most observable information known. Again, the most common of these charges for property are common area charges and CAMs, and we'll go through these a little bit deeper in a bit. Finally, beware of lease terms that differ from CAM and other component charge periods. So for example, let's go back to my leased car. It has a built-in bumper-to-bumper maintenance for the first year, but the lease is for 3 years. You know, in the first year, you know, the car company paid for every single thing down to the tires, you know, but the lease is for 3 years. So the liability calculation then would need to be adjusted as the maintenance agreement would not be in years 2 and 3. And you know, if you can estimate what your maintenance charges would be, and certainly a lot of car companies, they offer annual maintenance agreements. Are they a good deal or a bad deal? I'm not so sure. You know, but you know, typically your dealer would say, hey, I'll charge you $20 a month, you know, and you get all your common maintenance for free, included in that $20 a month. Well, that is a component. And since it's a component, okay, $20 a month per vehicle, that's $240 a month, a year per vehicle, and that would be a liability. It's as easy as that. And if you want to present value it over 2 years, sure. You can do that and just identify that separate from the lease. So there are 4 steps in figuring out components, and they're on this slide. First is recognizing and identifying them. Now, some have said to me, hey, can you use artificial intelligence or screen readers to find the components within leases? And I've seen demonstrations of this before, where you feed into a scanner, a PDF document that could be decades old, and the artificial intelligence tries to find components within leases. I've never seen it work. The best scanner are your 2 eyes. They really are. You really have to read these contracts. The next step, if you can't identify the components in the contracts, is to look for similar contracts. Now, again, the example I did of the 1-year maintenance contract on a car is just that. However, if we didn't know how much the dealer charged for that annual maintenance, if we didn't know the $20, or if it was completely variable, professional judgment is okay. And this is similar to setting an indirect cost rate or something like that. If you're over or under, adjust it. But if that's still not practicable, then it's part of the lease. And that leads us to our next polling question. Okay, so here we got a lease contract conveying the right to use a building for 30 years in the attached parking. That's a long lease. In the attached parking garage for 15 years for the government offices. There's no stated interest rate, in the lease agreement. And so there's other stuff here. Do you believe the discount rate should be separately assessed for each component? Yes or no? And this is actually a GASB implementation guide question.
Most of them are saying yes, though.
Most are saying yes. Okay. Well, again, GASB 87 this is Q&A 4.61, by the way. GASB 87 requires that lease contracts involving multiple assets be accounted for as separate components if the underlying assets have different lease terms. The reporting of these components instead of one asset, you're going to have 2 components. It may affect the discount rate implicit in the agreement. In addition, the incremental borrowing rate may differ between these 2 components because of the differences in the lease terms. So think about it in your home mortgage, okay? So a 30-year mortgage rate under normal circumstances is going to be very different from a 15-year mortgage rate. And so that's why GASB did that. And so there may be different rates and you may have different amortizations. Does it all end up in the same place? Yes, but you may have different rates and different amortizations. So that's pretty good. Here, I'm going to get this off my screen. Okay, so combinations are different. To me, they're my best friend. I love combinations. So instead of leasing hundreds of printers and copiers at the same time from a leasing company, only one lease document is needed as the terms and conditions are the same with the same counterparty. And I've seen these with sheriff's cruisers, office space, laptops. The laptop I'm talking to you on right now is probably part of a fleet of laptops from the same laptop company by Eide. And, you see this a lot. So again, I encourage you to, when you're getting organized with GASB 87, and if you see a lot of these, so for example, this laptop is ThinkPad from Lenovo. So if you see a lot of agreements with Lenovo, and if they're all at the same time, say for different departments or so on and so forth, chances are they're a combination. If you see a lot of agreements with Ford for police cruisers or sheriff's vehicles, that they could be combinations that are out there. And so try to find these, and it may lessen your work. Incentives are also common. And again, you're seeing this a lot these days. You know, you see all the time in the newspaper here in Washington with, you know, apartment buildings trying to give 3, 4, 5 months for free as an incentive. I mean, that's a serious incentive. If you're going to give 4 months or 5 months out of a year for free, that's a darn good deal. And again, you see these in car commercials, and we'll pay your closing costs or so on. You know, there's a lot of things like rent holidays or concessions. You know, incentives, you know, need to be known as they adjust the accounting for the asset and liability. And again, you know, it's very common to see these, especially, you know, in big cities. I mean, here in, again, in Washington, D.C., there was another ad over the weekend in Northern Virginia, in the area where Amazon HQ2 is being built. That's called Pentagon City. There's a building right across the street that was offering 3 months for free if you sign a 12-month lease. That was unheard of a year ago. And they would have laughed because they said, GHQ2 is right across the street. Why are we giving you 3 months for free? That is an incentive. The accounting establishes a present value for the incentive, and that's amortized based on the timing or stream of those incentives. So again, you're going to see a lot of these days due to COVID. And so, you know, certainly, you know, check out your agreement, especially if it is a new agreement for these sort of incentives that are there. Modifications and terminations are probably also going to be common. Modifications occur when an amendment occurs adjusting that all-important time factor, or in some cases, the all-important interest factor, if it is stated. But as I mentioned a few minutes ago, you know, interest rates aren't that common to be stated in the lease agreement. You know, modifications can be terminations if the right to use asset decreases. You know, we're both, you know, we're the lessee, you're a lessee government, you decide to walk away from the property, and the lessor agrees to that by writing down the lease. Well, that's both a modification and a termination. If assets are added, say a brand new police cruiser that wasn't involved with the lease before, then the lease may need to be recalculated. But if a termination occurs, say early, you know, again, you're going to vacate the lease, you're going to vacate the property, it may result in a gain or a loss. And these need to be known as part of implementing GASB 87. So let's go back and see what that looks like, you know, and terminate a lease and, you know, after a few years, you know, so after all, in this case, we're going to be the government. We're going to be the lessor instead of the lessee. And the accounting is symmetrical, you know, for the most part here. Here we, you know, have COVID going on. The private party leasing a big piece of space, in this case, a hangar at an airport, is having difficulty. And in this case, again, the airport is a lessor. And the lessor agreed to adjust the lease receivable down to $270,000 from $500,000. In this case, only the statement of net position entries are needed, adjusting the receivable and the deferred inflow of resources that we'll talk about in November, because that's what you record as a lessor. Had the lease been vacated and the private person walks away totally and does not intend to use the hangar property anymore, well, that would have been a loss. Now let's put it on the lessee side. Okay, since, you know, this particular webinar, we're talking about lessees. For the lessee, the lease liability would be adjusted, but also the lease asset by the $230,000. Had the lease been vacated just at that, you know, and the parties walked away, a gain could occur net of any accumulated amortization for the lease asset. And again, it's up to how you amortize that asset. We have to remember, though, that there might be a termination penalty involved with a vacated lease. And the penalty would be an expense, a debit, and a cash outflow. Now, any gain or loss is under management control because you, as the government lessee, you decided to walk away from the lease. And it would be a special item if it's unusual or infrequent, or if you as a government are really a bad risk and you like to walk away from a lot of leases and none of the landlords are really doing business with you anymore. Well, guess what? It's probably not a special item because it's probably not unusual or infrequent. But beyond the scope of today, the presentation of special items and extraordinary items, that could change very well in the future because of the new financial reporting model project. Stay tuned. We're probably going to have a financial reporting model webinar coming up during the winter or early spring of next year before the exposure draft comments are due. This one is a page to bookmark. All of your debits and credits for lessees and lessors are on the same page. You'll see this again coming up in November. And yes, I know I should have adjusted the column on the left to get the T for subsequent over there up on top. But you know, that's not our biggest deal here. If you're a lessee, take a look at the debits and credits in the first and third rows. So you're going to declare an intangible asset, and your liability is the present value of your future lease payments, and there shouldn't be a deferred inflow of resources. There is no deferred outflow of resources. After that, you amortize your intangible, and your intangible is going to go to either amortization expense or depreciation expense. It really depends on how you book things in your local government jurisdiction. I've seen them both ways. I kind of like amortization expense, you know, as your best way, your best practice. And then you're going to reduce your lease payments by your lease payments, your liability using the effective interest method. Your disclosures, guess what, folks? They're remarkably the same as you do today for capital leases. The existence, terms, and conditions of any guarantees or variable lease payments would be included in there, along with any impairment losses that caused a termination, such as a fire in your office space or a breakdown of your equipment that is permanent. You know, let's say a police cruiser was involved in an accident and it's totaled and it's material. Well, guess what? That could be a termination. Any form of commitments for the leases not yet begun are also required to be disclosed. Now, what am I talking about there? Okay, let's say you sign a lease for a office space, but the office space needs a build out, and it's going to take about 10 months for the build out. And okay, it's September, and that 10 months gets us until next August. And you're not going to be able to take possession of that space until next August. Well, you have a commitment because you're going to finance that build out, but you really don't have a lease as of yet because you haven't taken possession of the property until you can actually locate your staff within that office space. And so that's just a disclosure of a commitment, but there's no real asset or liability unless you had some form of down payment made on the lease. And so it's just a commitment for a brand new lease. So that said, let's talk as to what I've been calling for, it seems like years now, special case leases. Special cases include things like sublets, sale leasebacks, leasebacks, and leases between related entities. You know, our lessor webinar coming up in November, we'll talk about things like regulated leases. But for now, the big deals are subletting, sale leasebacks, leasebacks, and related party leases. And you know, certainly due to COVID, subletting has been a little bit widespread. And And traditionally, subleasing has resulted in net transactions, even though there are three parties to those transactions: the original lessor, the original lessee, and the new lessee. Under the new provisions in GASB 87, the original lessor stays the same, but if the government is party to a sublet, the government would not only be a lessee, but a lessor. The transactions do not net. And where again do you see subleases? I got to tell you, you see them a lot with higher education, especially in what I like to call student villages. It is a common occurrence, and under current GAAP, you may have netted all these transactions. Well, guess what, folks? The world of netting transactions is going away really, really, really quickly, not just in leases, but in other forms of contracts. And again, beyond the scope of today. But the GASB's revenue and expense recognition project could signal an end to the netting of transactions like this, should it come to be in a final standard, perhaps in 2023 or so. And so you may see this stuff over and over again. And I know one of our friends from the GASB is listening to this webinar, and so certainly this is on the docket here. So just beware. Sale leasebacks, these are hard. There is a sale that truly needs to be a sale, and that includes consideration and the buyer taking control of the property sold. The provisions have not really changed from the current standards, though. And they're indeed a high-risk transaction because they do not happen often. The riskiest part is determining whether control of the property has truly transferred, or is there some form of inside transaction, say between parties within the reporting entity. And there could be some off-market terms, related parties, delayed consideration and things like that. And all these need to be calculated and disclosed. The bottom line is that these are two different transactions, the sale price and the leasing back. And there truly needs to be a transfer of control. Case in point. So my kids here in Washington, D.C., they have a house in the Navy Yard, which is a really up and coming area of the city, and my grandson lives there, and so on. And it's right near the ballpark for where the Washington Nationals play. So a couple of days ago, completely out of the blue, somebody, a real estate agent, called them and said, "We know you are not marketing your house right now. It's not on the market, but we may have a buyer for you." And so my kids said, "Well, we're not selling." And they said, "Well, we may have a buyer of your house." And so the buyer came over, the potential buyers, a young couple, came over on Monday evening a couple of days ago and took a look at it and loved the property. And apparently they're preparing a bid for the property. Now, the property is not on the market as of yet. And so the realtor is obviously very excited. The kids are very excited to see what it is. But the problem is they have to move all their stuff out and they need to find a place to live. And so I said, "Why don't you do a sale leaseback?" And so the buyers may agree to those terms, and they're negotiating that as we speak right now. The buyers may agree to those terms that my kids can lease the property back for 3 months while they find a new place to live. But that's two separate transactions. We're going to have a brand new lessor, which happens to be a private individual, not a government, of course, and my kids will be lessees. if that indeed is the case. Now, of course, they could live with my son-in-law's parents and they would pay nothing, I assume. And so that might be the case, and maybe that will go forward. But understand these are two different transactions. Now, the present value, now let's say my kids were a government, the present value of the lease payments would need to be recorded as a liability using market rates, even if there are off-market terms. Any form of difference between the terms and conditions in a lease and market rates would be a borrowing. Your disclosure would be exactly the same as a lessee-lessor transaction. So again, be careful with these sale leasebacks. Leasebacks, these are a lot easier. The asset gets leased and then gets leased back, and therefore the transactions may net depending on the property involved. A common leaseback situation might involve office space within the same structure or complex. And for whatever reason, the government doesn't need that office space as a lessor or a lessee. And in this case, the leaseback transactions do net. The accounting and financial reporting would be the same as prior to GASB 87. And this one's a little bit esoteric, and so we're going to talk about this more coming up in November. Leases with related parties are also important to know. Now, remember, related parties are defined in some state statutes, and in fact, there might be reporting due to ethics and so on, especially for governing boards or other personnel or related organizations. The leases involved may have off-market terms such as sweetheart deals. These things need to be disclosed likely within your notes to your notes to your basic financial statements. Again, don't combine these. Especially if they're with entities within your reporting unit. If there was a lease between a primary government and a discretely presenting component unit, or between them, treat these the same as other leases, but don't combine the flows, don't combine the balances with any other due tos or due froms or receivables or payables. Don't combine with leases that are outside your reporting entity. So treat these separately because they are related parties. Here's an example of how to document something. You may want to sort of set up a spreadsheet of your reporting entity and sort of circle all the related party leasing transactions that are going on. Now, in this case, let's say the airport leases to the sheriff or in the fire protection district. Well, since that's within a blended component unit, and it's a major enterprise fund that's part of the primary government we're talking over on the right-hand side here, and the sheriff or the fire protection district is sort of over on the left, and the sheriff's special revenue fund is also a government fund. The new GAAP doesn't apply. That's just a due to, due from. Let's say we have a public finance authority that's leasing property to water protection district, and they're over here on the left-hand side. Yes, they're blending component units, but they're legally separate. The new GAAP does apply, but eliminations are made at the financial reporting level. Now, let's say we have a discretely presenting component unit that leases from some entity within the primary government. The new GAAP does apply on the separately issued financial statements. And so when you're thinking about your related party leases or leases within your reporting entity, it's almost a best practice to do one of these sort of charts and figure out who's going to lease to what. And remember, when you do have separately issued financial statements for component units or funds or things like that, it's just as if they had implemented GASB 87 separately, but it all collapses on itself to do tos, do froms, for the balances or transfers back and forth, if that does occur once you do the entity-wide financial statements. So again, figure out the form versus substance on these related party transactions, figure out the compliance requirements, figure out if there are sweetheart deals in these, especially involving your governing board. So with that, let's go to our next polling question. So here we have a county building authority. They're a blended component unit of a county. The building authority constructs public capital assets and leases them to a county. Should the leases with the county be eliminated as intra-entity leases in the financial statements of the reporting entity? Is it a no or is it a yes? What do we think on this one?
Well, it's more yes, but there's a fair number of no's.
Okay, all right. Well, given the, I'm going to do the 80-20 rule and deference of time. In this one, yeah, and notice I sort of swapped, usually A is yes and B is no, and I did that just to make sure you're awake. And I know if you're in the mountain time zone, you're probably, grabbing a sandwich or something like that. If you're in the Eastern time zone, it's after 2 o'clock, and and if you're out west, you're hungry. This one, the answer is yes. When the lessor is a blended component unit, the debt and the assets of the lessor are reported as if it's, in this case, the county's debt and assets. And if the building authority issues a standalone financial statement, the leases are then reported in those, financial statements. And this is pretty much straight out of the GASB implementation guide, referring to paragraph 88 in GASB 87. Now again, in the building authority's separate financial statements, then they're issued on a standalone basis. They're going to implement GASB 87 and show these leases separately. And as such, since they're going to show these leases separately, it's going to be as if GASB 87 didn't existed, and the eliminations didn't exist, excuse me. But for the county's, general purpose external financial report, the government-wide financial statements, all this stuff is going to be reported at the debt and the assets of the lessor are going to be the county's debt and assets. And so in some cases, it may be eliminated. So that's a very important question that's there. Okay, so I mentioned at the outset that we've had actually a couple of clients starting to implement GASB 87, which is great, and they're very forward-thinking clients that are out there. They're wonderful clients doing that. And we, when we implemented GASB 87, it's not like we were know-it-alls. And look, I've been working on what became GASB 87, looked at the board papers for years. And still there were nuances within GASB 87 that I kind of had an aha moment. And I know a lot of our team is on the webinar today, and there are folks who work with us, on some of the implementation of GASB 87 at clients. And there were a bunch of those aha moments that we had. We learned a lot of lessons, and hopefully these lessons we learned as a firm will help you implement, or what, if you haven't started yet, given the fact that we have the battle scars of implementing GASB 87, hey, we can maybe help you. So in this particular case, we implemented, in this example, we implemented a large county in a western state. I'm not going to say where it is. We had elected officials in addition to a governing board. There were 18 functions of government including a county hospital, a sheriff, a treasurer, tax collector, fire protection, the usual suspects that you find in a general purpose government. In this case, there were many situations where the county was not only a lessee, but also a lessor. We also had some subleasing situations going on. We had an airport that luckily the airport was not a commercial airport at present. Mainly it was a cargo airport or a private plane airport. There was a major passenger airport subject to FAA regulations beyond what is cargo and so on. And those FAA regulations, pretty much determine passenger jet service and so on. And we'll talk about those in November, but that's not within the county. So each department had files on leases, which was great. Some of those files were decades old. Some of those decades old contracts were on a month-to-month basis for many years. They did have a general administrative function that had great broad guidelines, but it caused us to, and it caused the clients to take a look at those guidelines and policies, and those policies and procedures are important, and we'll revisit those again in a few minutes. But you really need to think about those policies and procedures. And I know these clients are going to be continuously thinking about those policies and procedures throughout this year, until the first audit under GASB 87, because they implemented early. And contracts that we looked at routinely had fiscal funding clauses. This is going to be something that you that you're going to encounter as you take a look for GASB 87. One of the initial tasks we had was to do an entire day of training, just like we're doing right now, for operational and legal staff from a lessor and a lessee perspective. You may want to have something like that, because a lot of operational folk, they just don't understand what you're going to be asking for, nor should they. From an accounting perspective, because they're not accountants, they're operations people. So you need to really engage them as to what's needed. The accounting staff were present, and they provided a plan of action and a discussion of the project scope. The county that we implemented, was upgrading its ERP system. They thought this was an opportune time to expand and to include GASB 87 information, which was great. We started off this project prior to COVID. COVID wasn't even an acronym in anybody's mind. And when the exposure draft to what became GASB 95 was issued, we had a great conversation with our decision makers. And we said to them, hey, do you want to put on the brakes or keep going? And it was great. They wanted to keep going, and we encouraged them to do so. They, are a highly rated government that's out there, and they pride themselves on really implementing a lot of GAAP and issuing timely financial statements. We began our contract right at the beginning of COVID. Again, it wasn't really widespread. We were supposed to do training in March, but COVID shut that down. And we went virtual over a space of a few hours, establishing a portal for documents, and we really pressed on, and we didn't lose one step at all. Approximately 250 leases were originally analyzed from the departments. We took the analysis and we finished this project in about 60 days, and then we set up the amortization schedules after clearing a bunch of open points. That took around another 30 days because we had to do some adjustments based on new information and so on. But we finished up right about when the ERP system was going live on June 30th of this year. And are we going to have some stuff on an ongoing basis throughout this year? Well, for sure. Absolutely, we're going to have some ongoing stuff. And that's what happens. If you think back, for those of you who implemented GASB 34, of which there are fewer and fewer as years go by because folks have retired and so on. For those of you who implemented GASB 34, you remember implementing capital assets and especially infrastructure. And it seemed like every single year you found some new piece of infrastructure or found some new capital assets that you just didn't count the first time. You ended up having to go take a look and then do a balance adjustment, a beginning balance adjustment to make those adjustments. And I fully expect us to find stuff as we keep going on and on and on throughout the next few years until those policies and procedures get really ingrained in the operations, folks. We learned a bunch of lessons that were out there. And it seemed nearly everything caused us to take another look at GASB 87. The wording in the standard is really precious. And in some cases, we did call the GASB and ask for clarification, some of which became the basis for additional questions in the GASB 2020 implementation guide update. And so those, you're going to run into situations where GASB staff didn't think about that as they were putting together GASB 87, and so they fully expect it. Our first policies and procedures focus was on completeness. Traditionally, the county had siloed departments, leaving decision-making up to the individual departments based on broad guidelines by the central service entity. That left the county with an important decision. Do you centralize all this information from the departments or decentralize? And what do you do with document warehousing? Ultimately, the county decided to leave things as is, and that's perfectly okay, understanding that there may be a completeness problem. And so you're going to be running into this stuff on an ongoing basis. The next set we reviewed was legal documents, and it also concerned, internal controls over who can establish, who can sign a lease, who can negotiate changes. We were especially concerned with legal property tax limits and legal debt limits. We asked about that. Was adding GASB 87 liability subject to those limits? We had to get counsel involved. Luckily, it wasn't to the best of their knowledge in this particular jurisdiction, but your jurisdiction may be different. For example, in Colorado, they have the Taxpayers' Bill of Rights. And you need to think about whether or not adding debt that wasn't authorized by the citizens, and a lease is a debt, adding that debt has a problem with the Taxpayers' Bill of Rights. And so, and governments across the country have these legal ramifications, and you need to think about that. The discount rate setting issue was also an important decision, as the client was not only a lessee but also a lessor. Are they going to have a risk premium for lessees? Are rates going to ascend based on the lease term? Who sets the rates and resets the rates, and when do they do that? Ultimately, the Treasurer's Office, in conjunction with the Auditor Controller, settled on a rate setting process and on a process to set implicit rates. The process of establishing and calculating components was lengthy, as every lease was different. We even had a lease that included 4 full-time equivalent staff from the lessor permanently assigned in an equipment, and this was an equipment lease, and these 4 full-time FTEs were there to service the equipment full-time for the non-cancelable portion of the lease of 5 years. And then incentives. Remember, the county is a lessor, and if there are incentives involved, it's a discount for the lessor. The policy needed to be established, and as a public entity, was it in the best interest of the county to provide an incentive to a lessee? And when we finalized the major portion of the engagement, the county was still thinking about that. But just remember, if you are a lessor and if you're giving an incentive on a property, you have to think about whether or not that incentive is really an abatement of things like taxes and so on, or some other payment, and whether or not that is politically, an issue, especially in this day and age. And that leads us to polling question number 5. And this goes to my government's policies and procedures relating to leases. And this is sort of an opinion piece. What do you think? Where are your policies and procedures relating to leases? Are they decentralized? Are they mostly decentralized? Are they centralized? Or I'm just not sure. I'd better get going.
So far, centralized is
Centralized is
ahead, but we have the large number for mostly decentralized too. So
okay. If you ask me, and this is my own personal opinion, and every government's going to be different, the more decentralized that you are, the harder it is to determine completeness, the harder it will be to take a look at your terms and conditions, uniformity, and so on. You may get a situation where an individual department makes its own negotiation and then doesn't even realize that something is a lease. And so just think about that as you get started. And in fact, before I even start on thinking about gathering the information, I'd almost look at my policies and procedures first and just see what's going on. And so think about that as you go forward. Here's some common issues that you'll see. Again, we had a bunch of issues that caused us to take a hard look at the documents. I mentioned a bunch of leases were pretty old. A bunch were non-exchange transactions. We had a lease of some property. In this case, it actually had frontage on an ocean. It was for 99 years at $100 a year, to a hotel. Well, that's a pretty sweet deal. That's really a non-exchange transaction because obviously $100 a year of beachfront property, you'd love that one. I'd love to put a house on a 99-year lease on beachfront property, except if it was in a tsunami area or something. There were lots of easements, especially for cell and fire tower access, land swaps, combination leases. There was one for copiers and printers, one for vehicles. And again, this will be common of governments from all sizes. And so just be aware that these are out there. After the initial upload, 39 leases were duplicated, and you're going to see that. That's okay. We're all, dealing with COVID. We're all dealing with a lot of stuff, and sometimes this is just in the back burner. And the county had great management that caught a bunch of these. We reconciled down to 211 separate files. About a third after the initial analysis, which took a bunch of time, was not subject to GASB 87. A bunch were short-term, actually without an option to renew, especially for things like harbor slips. So there was a handful of power purchase agreements in there, and there was even some SIBITAs that were in there, the subscription-based information technology arrangements. We held aside the subscription-based information technology arrangement documentation. We directed the county to do that and use it for GASB 96, which who knows, they may contemplate going early as well, based on this. Here's something that you may encounter. I blacked out, a bunch of the PII that was in there. This lease was actually originally signed in 1951 for communication towers that was still in use. The lease payment ended up being about $10 a year as of the last renewal in 1986. This is clearly, it's a non-exchange transaction. There's not equal value for value, because it's 457 acres of land for $10 a year. And it's really just an easement, and you're going to find a lot of these. The one thing I really want you to be careful of, as a government, you're going to be identifying a lot of personally identifiable information, especially if the counterparty is an individual. you may be asking them for tax identification numbers, social security numbers, things like that, so you can provide them a tax document. Really, before you hand it to us, please black that out. We really don't care. Your auditor doesn't care about that. We don't need to see personally identifiable information on that one. So just be aware before you hand that to an auditor. Here is a major contract with a copier printer vendor, and why variable payments need to be separated from fixed payments. This one was extraordinarily complex, as it contains variable components and non-lease components. Here we have the client decided first to determine the value of the 685 copiers without the extra components there, which was proper. The extra components were the supplies, of course, paper, toner, maintenance, the on-site service. We then discounted the equipment value, which was about $2.5 million, about $500,000 annually since the lease inception to the point of implementation. In attempting to get to the fair value of those components was nearly impossible. I mean, how do you value supplies? 5 years of a supply contract. And so we used our best judgment. We said, okay, if the $985,000 minimum payment, which was the calculation of all those minimum copies, the 2 and 1/10 900 cents, per copy. If that was going to be the minimum, well, that calculated out to $985,000. And if the equipment charge was $500,000 annually, well, guess what? The expendables was the difference. It was $485,000. And I think, one of my senior managers for helping to figure out that difference, my senior manager, Dave, and my staff, Mick and Lynn, for figuring out that difference. That was really important. And I know they're on the call today, and I wanted to give them a shout out. Also, this lease contained a $1 buyout, but the client maintained that they would not exercise the buyout. After all, you're going to be beating the heck out of these devices. Again, within the lease, there were significant components, including FTEs assigned to maintain the lease for the life of the schedule. And here are those 4 FTEs I spoke of a couple of minutes ago. It went down to naming the types of services that they would provide in this paragraph. And this was embedded within that many page lease documents that was there. So just be aware that these sort of things could be within your lease documents as components. Okay, how to implement. Each lease needs to be gathered and converted based on the facts and circumstances as of the date of conversion. Here's an example of a GASB standard that results in a beginning balance adjustment that could increase net position. And this is due to the value of liability outstanding, but also there's a value of an asset outstanding. And again, there could be a conversion entry that is very material. Without the conversion entries, without knowing the completeness provisions, there's no way to judge materiality or whether there are problems in recognition and saying, okay, I'm just going to go do things on a prospective basis. For you lessees out there, you have to take a look at each lease and then do the calculations using the facts and circumstances as of the point of implementation. Again, I can't emphasize materiality enough. And so let me just, for another second, just go down the road a little bit on materiality. And I know it's a little off topic, and not on the slide, but I just wanted to mention it to you because over the past couple of days, I've gotten a number of questions on it. Can I overlook this lease or that lease? Well, not so fast. There are a bunch of problems in trying to establish a materiality threshold. Your asset capitalization materiality for your government may already be different than materiality for liabilities. As an example, let's say you use a $50,000 capitalization threshold or a $5,000 capitalization threshold for an asset, but you have zero for a liability. As you've heard, GASB 87 establishes both an asset and a liability. So if you book one side and not the other in a lease as a lessee, you're going to have a liability but no asset. That doesn't make economic sense. Materiality for audit purposes is done by an opinion unit. The government-wide, in governmental activities and business type activities, each major fund and the non-major funds in the aggregate are all separate opinion units. How will you establish different materiality thresholds for each opinion unit? By the way, that's the auditor's job, not your job as a preparer. Materiality may have no impact on the discount rate setting process, the lease term calculation, components and payments, and finally, without knowing that you have the entirety of the population of leases, a materiality that is established may be really materially misstated. So as I keep saying, hold off on thinking that something is immaterial until you have the internal controls to capture leasing activity. What should be your plan? That's the big question, but a plan is vital. Again, since this is a retroactive statement and we need to convert all existing leases, you need to gather all your existing leases and analyze those facts and circumstances as of your point of implementation. I do suggest to do a dry run just to see where the issues are if you can. But who knows, you may not have enough time to even do a dry run. For those governments out there, someone needs to be in charge. And no, it's not your auditor who is signing your audit opinion. For our client we converted, we had the assistant CFO in charge, and she was marvelous, absolutely marvelous. And if you're on the line today, thank you. In doing this. She was there nearly every step of the way. She slept with GASB 87 and was a major problem solver. And the client established the timelines, the deliverables, holding departments accountable. Was it perfect? No way. And for this fiscal year, again, I'm sure we're going to be blocking and tackling. And at the same time, the client was also upgrading their ERP system, so adding extra stress. Figuring out a timeline and then working backwards, in some ways, you may be already late. And depending on your current internal controls and size, again, you may be late. For the states out there, I'd get going pretty quickly. The assessment phase of GASB 87 implementation includes developing a plan, gathering inventory data of your existing leases. I mentioned policies and procedures, and then making an initial assessment of whether additional technology or personnel or consulting is needed. Surveying your separate departments or agencies and operations is likely necessary for those entities that have the ability to sign their own leases. To do a further check, advanced data analytics can read your general ledger and disbursement journal to find recurring payments to the same payee. Just take a download of your ledger or your payment journal, and that may indicate a lease that is unrecognized. Next, implementation may include software, but not always. And we'll talk about that in a bit. The focus needs to be on the internal controls, and not only for conversion, but on a go-forward basis. And the last step is to prepare the accounting and financial reporting. Does your government need consultative services from Eide Bailey? It depends on your situation and what is your current skills, knowledge, and experience to implement GASB 87. We also have to worry about independence for our existing audit clients. That said, we can provide technical assistance to audit clients as long as we don't compromise our independence. For non-audit clients, if you think you need consultative services to implement GASB 87, we can provide a range of services to your government, ranging from a full implementation project, assuming your government has somebody in charge to manage the services, to just being on the other end of an email or a Skype call to provide answers to your GASB questions. And I do that a lot. Or something in the middle. We're here to help you. We know the state and local audit guide is provisions are going to focus on completeness. To do so, we need to gather these items and to review internal controls on recognition. For example, we need to analyze the ledgers and journals, again, for these recurring payments to the counterparty. I gave you that tip. That's probably going to be an audit step, because we're going to look for an unrecorded liability. We also need to work with you on potential issues with laws, regulations, and grants. And I mentioned debt limitations and so on. Finally, there are things that are so far we are seeing in policies and procedures. For example, interest rate setting process. Now, that could be a significant accounting policy depending on the type of government that you are. The implementation guide is freely available and has lots of questions that'll help you through this process. Now, note that there are additional questions coming in the 2021 guide that should be out as you implement. It's not prepared as of yet, but they are gathering questions from practitioners already. Remember, also, there are questions in the 2020 guide, the implementation guide update, but due to COVID and GASB 95, the implementation of those is now aligned to GASB 87. To do and here are some of the topics that are within the existing implementation guide. If you think you have any of these topics, take a look. Again, they're pretty vital. That's out there, and there's going to be more that are coming. And there are a bunch of illustrations that are in the implementation guide already. There's probably going to be a bunch more that are coming in the future. We separated leases into 3 baskets as part of the implementation process. And those that are currently capital leases, and those that are operating leases, and those that are all our special cases. Once we figured out those baskets, we reviewed for terms and conditions, incentives, and then ran the calculations and prepared the, prepared the disclosure. It's a gathering of that population is where we did the bulk of our work, and we work hand in hand with our client. And then it's up to them to keep things going on a go-forward basis. But it's our job to help them through some of this blocking and tackling. Some RFPs have been issued for lease software. Before you issue an RFP, you should take a hard look as to what you're doing with your current capital leases. The gap is not all that different from your current capital lease structure. You may not need a new system unless you don't have a system to begin with. Now, for small governments out there, extremely small governments out there, a filing system using manila folders with internal controls and maybe Excel with internal controls, that may work. For anything beyond the smallest governments that are out there, you may need some software, and you may need a hard look at your policies and procedures, and in that we can obviously help you. Obviously, also take a look at your workflow and documentation that's out there. Again, your software solutions are not always needed. Some governments may only have a handful of leases that are out there, which can be, again, done by Excel with good internal controls. Excel really is decent, with Office 365 and maybe using things like OneDrive. You have a on the cloud solution. But remember, you still got to have those internal controls over financial reporting and management of your spreadsheet. So password protect them and so on. Some functions are built in, and I gave you some of those functions earlier on this afternoon or this morning. And remember, whatever function you choose, be it Excel or be it paper-based or be it a software solution, whatever it is, your underlying documentation of these transactions are going to last a long time. Key focus areas are going to be on the risk of material misstatement for the audit. And this is speculative, by the way. From an audit perspective, nearly every audit assertion may be impacted: completeness, recognition, measurement, presentation, disclosure, compliance with laws and regulations. By the way, since leases are dead, you got to again think about your continuing disclosure agreements with your bondholders and, of course, those pesky related party transactions. These assertions are going to impact a lot of areas of implementation, from transition to reporting. Completeness will be a key area, as I've been mentioning over and over and over again. You're going to have fund transfers and leases between departments, leases between programs, and so on, all of which needs to be mapped out. I mean, I can imagine a whiteboard full of stickies with a big "do not erase" on it. And hopefully you have internal controls and somebody takes a picture of that whiteboard so that somebody doesn't come in at night and erase all your notes. Obviously you can do that electronically, of course, too. I mentioned a bunch of other areas of risk, like modifications and terminations and subleases. There's going to be a lot of these areas that are going to impact your audit assertions, all of which need to be thought of and documented. GASB 87 may even have an impact on the single audit. And more succinctly, your grant operations. Start looking at your current leases. If there are federal funds being used for leases, we can at least identify these and ensure that they follow the uniform guidance. Now, the Uniform Guidance Section 318 says consideration should be given to consolidating or breaking out procurements to obtain a more economical purchase. Where appropriate, analysis is required to be made of lease versus purchase alternatives in any appropriate analysis to determine the most economical approach. And I read that word for word from the Uniform Guidance just now. What does that mean? It means for grant purposes, they will only reimburse the depreciated amount purchased property versus leased property. And so you got to do that analysis. And similarly, Section 465 limits the allowable cost of rental payments, you lessees out there, to the extent that they are reasonable in accordance with market rates and are less than what would have been had the property been owned. So clearly, single audit makes an impact on GASB 87. Now, GASB 87 hasn't updated single audit, and the compliance supplement doesn't mention GASB 87. So just be aware. Now let's dig a little deeper on completeness. I've mentioned it over and over again. Your auditor might be asking you about your policies and procedures. How did you gather your information? Is the government a lessor? Is there some form of fiscal funding clauses? And then what sort of integrity is involved with the data? You can look at these a little bit later and keep these for your edification. In terms of recognition and measurement, the auditor is going to want to sample leases and recalculate them. The auditor may want to take a look at certificates of participation in conduit debt and whether or not these are disclosed properly, especially with new stuff coming on in terms of conduit debt in the future. That's coming up in 2022. And then, of course, presentation and disclosure. Have you disclosed in accordance with GASB 87? Have you restated your beginning net position in accordance with GASB 87? And then compliance with laws and regulations. I mentioned grants. Has the lease been properly approved by those charged with governance? Have you violated any debt covenants, including continuing disclosure? So that's about it in GASB 87. No, by the way, I forgot related parties. Are there any sort of sweetheart deals? Are there anything that will make the newspaper because of insider transactions and so on? At least between those charged with governance and the primary government. And again, single audit. Just be aware, the federal guidance has not been updated yet. I have heard that the uniform guidance may be updated coming over the next few weeks or months. Whether or not that is updated, I have no idea beyond the scope of today, but we have heard it may be updated. But by and large, the current uniform guidance has these provisions, which may cause you to think as to whether or not you got a cash flow problem for these grant-funded transactions. So with that, we have just a few minutes left for our last polling question and maybe some questions and answers. So thinking about what I heard. Am I more confident with GASB 87? You're like Julie Andrews in The Sound of Music. I have confidence. I can do this. Or are you B, thinking about retirement and worried as heck? Or C, considering hiring Eide Bailey to help you implement GASB 87? Or you're just not sure? So somebody asked, they found it difficult to get information from organizations that lease copiers. Is there good guidance on how to work with these companies to determine the real purchase price, the interest rate being charged, and the maintenance cost? Oh, yeah, that's a hard one, and we found that hard. You might have to look, let's say you're a K through 12, and I don't know who this person is, it's anonymous. Let's say you're K through 12 and you have similar supply and maintenance contracts for paper and so on. You can take a look at those supply contracts and figure out your components from that. And then in terms of, your interest rate being charged, you may want to ask your treasurer and see, if you happen to have a 3-year lease on the copier or a 5-year lease on the copier, see what you have in terms of similar debt. Let's say a 3-year ban or a tran or so on, or a 5-year ban or a tran. What's the current interest rate? And I got to tell you, another place to look is the bond buyer and figure out what your borrowing rate, your bond rating is, and maybe do the math based on your bond buyer. But you got to have a policy or procedure to determine that. And then based on the payments of those fixed payments, just do the present value, taking out those supply and maintenance contracts. Okay, now somebody asked about materiality. So the capitalization, they asked about the capital asset threshold, and you might have a liability but not an asset. So what's recommended? I gotta tell you, I wouldn't go down the road of materiality as of yet until you know all your, or at least the vast majority of the numbers of leases that are out there, if not the numbers, the dollars of the leases that are out there. You got to do the surveys of individual, departments that have their ability to do their own leasing. You got to do sort of independent checks of your general ledger and your journals for cash outflows to the same counterparties, and then so on. You're going to find that information that you're going to see some leases that that just didn't get recorded. And as such, that'll hopefully whittle down. And then once you have the complete population of leases, then if there are truly really small stuff out there, talk to your auditor and say, I'm finding a lot of leases for $100 a month. Can I do away with those? Well, if that lease for $100 a month is for 640 months, that's between you and your auditor. And remember, we got to think about leases at each opinion unit. We got to figure it out at the entity wide, at both governmental activities and business type activities, the major funds, and then the non-major funds in the aggregate. So we really got to think about it. So just work with us and have an open line of communication, which we always like to have with you. And I guess our last question, because we're bumping up again. If we have a blanket purchase agreement for a certain type of equipment, but the actual orders are against the BPA are not placed at the same time, can it be considered a single lease based on the BPA? Or is the lease contract not truly created until the order is placed? That's an awesome question. The question is, does the recipient of those pieces of equipment, do they have control over those pieces of equipment at inception? And if in BPAs, the answer may be no. So until they have control over those pieces of equipment, it may not be a lease. It may only be a commitment. And that's why I said those commitments need to be disclosed separately if material. It's almost like an encumbrance in budget accounting. You know, in budgetary accounting, you have the encumbrance process. You say, hey, we have this many million in encumbrances at the end of the fiscal year. And so with that, let's see what it says. We're more confident on implementing GASB 87. And I have a few of you thinking about retiring. And I have a few of you considering hiring Eide Bailey to help you implement GASB 87. I like to hear that. So with that, I thank you all for your time today. And certainly I thank Nanette for our participation. If you need us, please feel free to reach out and join us again for another webinar coming up in November for the lessor side.